We're half an hour away from the opens in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Good morning from the Asia Pacific. Our top stories today. Donald Trump returns to rocking the markets with social media posts announcing he'll jack up tariffs on Chinese goods by an extra 10%, blaming the influx of illegal drugs.
The U.S. president-elect also proposing a 25% tariff on all imports from Mexico and Canada, sending those currencies lower as the dollar nears a two-year high.
And we are already on bear market watch for Chinese stocks, particularly in Hong Kong, with the new Trump tariff threat only set to add to the post-stimulus blues.
You know what, Dave? Just a couple of hours ago, we could have spent the whole morning talking about the day two reaction to Scott Bessent coming in as Treasury Secretary. But the fortune has very much turned around in the last 90 minutes or so with this news that Trump is going to be levying additional tariffs on China, Mexico and also Canada. So that is really playing out in the market sentiment. We have seen sort of a reversal of fortunes. The broader benchmark now trending 0.8% to the downside. U.S. futures as well flipping into negative territory. What has been the standout in all of this is the moves that we're seeing in yields here as well, because you've got that dollar gauge shifting high. You're also seeing yields inching back down. The 10-year, though, just trading fairly steady at this point in time. Oil as well, that's more around that dynamics around demand, also growth. We are seeing that down 0.4%. Let's switch on, take a look. Again, really honing in on the market reaction. As I said, it's strong dollar. King dollar, that is what is really coming through. You can see here the moves that we've seen in U.S. futures as well. As I said, shifting down into negative territory. So really some concerns coming through. What does this Trump tariff risk mean? And how is that also going to impact global economies moving forward? So we'll get more details on that in just a moment, but I do want to have a quick look how Chinese futures are looking ahead of the open. As we said, counting down to the open of mainland markets. We see Chinese futures in the red here. As we said, Dave, already we're on bear market watch. Yeah,
we're very close. And in fact, on the Hang Seng Tech Index itself, we have taken out the 20% threshold. We're about 2% away, give or take, on most of the major benchmarks here in Hong Kong. And the other thing now suddenly that's back on our agenda today, it wasn't up until a few hours back, is what the PBOC will be doing as far as the fixing goes to in some ways anchor this weakness we're seeing in the currency markets, not just the Chinese currency, as Bella was pointing out. It's everything but the dollar except for the yen. So there's a clear risk-off move we're seeing in markets. So bring in Stephen Engel for more on these Trump tariff news. So I was a bit confused looking at some of the numbers, Steve.
Yeah.
Just take us through what we know so far here.
Well, what we know is that Donald Trump is getting a jump on his second term as president, at least 2 months before that inauguration date on January 20th. So that's what these, I can't call them tweets, they're Truth Social messages, at least 2 of them that he's laid out his plan on day 1 for tariffs. And, you know, we all know that Donald Trump says he loves that word tariffs. First of all, this is an attack as well on China and fentanyl. Mexico on fentanyl, Mexico and Canada on illegal immigration. 2 big issues, obviously, on the campaign trail, especially the building of the wall and the like. Let me, so we don't have to parse his words, I will read his words. I have had many talks with China about the massive amounts of drugs, in particular fentanyl, being sent into the United States, but to no avail. China essentially promised that they would institute maximum penalty, that of death, for any drug dealers caught doing this. But unfortunately, they never followed through, meaning Beijing. And the drugs are pouring into this country, mostly through Mexico, at levels never seen before. Until such time as they stop, we will be charging China an additional 10% tariff above any additional tariffs on all of their many products coming into the United States of America. So the way I'm reading this is 2 additionals. So additional 10% tariffs on top of any additional tariffs. We all know that there are 25% tariffs on about $300 billion worth of Chinese exports to the United States that were put in place in the first Trump administration and not rescinded by the Biden administration, still in place. Trump has talked about raising those to 60% across the board on all products. So I guess we're talking about, again, we're parsing the words, an additional 10% on top of that on day 1 through executive order. The other ones will be played out, obviously, through negotiations, potentially with other trade negotiations with China. But the added weight of this is the second message that he sent out, essentially adding Mexico and Canada, vowing 25% tariffs on Mexico and Canada because of the fentanyl issue and because of illegal immigration. Keep in mind, many economists I've spoken to say this is going to be a very inflationary move because if you look at Mexico, Canada, and China, by far, the three top trading partners with the United States. In fact, Canada, its biggest export to the United States is energy, gas, and crude oil. 57% of Canadian exports to the United States are energy, autos, which is under fire as well in the United States, and consumer goods. And also the integration of the automobile supply chain and agricultural products to the United States and Canada, so integrated. So if they're going to have a 25% added tariff on top of, or on top of all the other sort of protectionist measures that the Trump administration has talked about, this potentially is going to be passed on.
Well, we're seeing it right now in that chart there, the biggest
There it
trading
is.
partners. But it's not just tariffs, there's also sanctions that talk is floating around this morning. But this is a separate issue, of course, the EU and G7.
Separate issue, separate issue. Yeah. We're talking about maybe Trump getting a preemptive move on his stint in the White House. I think the EU is getting a jump on any potential treading, if you will, by the Trump administration. Because look, Donald Trump, I'm not interpreting what he has said. He has said he's been very skeptical of continued U.S. support for the war in Ukraine against the Russians. So I think the European Union, they've had 14 rounds of sanctions on Russian entities and others up until now. This, according to documents seen by Bloomberg, the EC, the executive arm of the European Union, European Commission, is drafting a next round that would target, for one, some drones, attack drones that are being found on the Ukrainian battlefield, as Bloomberg News reported in July, similar to ones designed in Tehran, but this time the allegation is that Chinese entities have been aiding Russian manufacturing to build these drones. In addition, there's potential restrictions on Russian oil tankers. Again, the Europeans want to limit Moscow's ability to fund its continued war in Ukraine. So basically cracking down on at least 45 different oil tankers into European ports. That's part of it. It's wide-ranging, including entities in Iran, in Syria, in North Korea. Obviously, there was a segment in that the document that we've seen that condemns, obviously, the North Korean soldiers going into the battlefield in Ukraine, but also Chinese entities, and as well as even Hong Kong entities. So. We're going to be talking about this for a while. We're going to be headline surfing for a while, and market participants are going to be headline trading.
Oh, we're here again.
Yeah,
we're here again. This time of the day, 8 years back.
But big questions as well, the role that Hong Kong is playing and how that could also play out. But that was our Chief North Asia correspondent, Stephen Engel, there. And earlier we actually spoke to the Minneapolis Fed President, Neil Kashkari, about how Trump's previous tariff threats could affect global trade and his views on Beijing's battle to revive its economy.
There's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path? Reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to, but I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
And that was Neil Kashkari, of course, their Fed president, Minneapolis Fed, speaking with, of course, our colleague, Linda Ahmed. It's going to be an extremely packed show coming up here. NF Trinity weighs in on the risk outlook given the latest we know from Donald Trump. Morgan Stanley explains why they see a bumper ride for Chinese equities ahead. Nomura Research Institute Richard Koo joins us in the next hour to talk us through whether or not it's too late for China to pivot the ship away from a balance sheet recession, if in fact we are in that. And we'll be speaking exclusively with Kingsoft Cloud, one of the best performing stocks in the region this quarter, on the outlook for their company. Counting down to the open of trade, 19 minutes away, Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell. Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate when your comps get tougher. How much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
At the Fed, at the end of the day, no matter who is in these various positions, we know what our job is. We have to get inflation all the way back down to our 2% target, and we have to try to keep the labor market strong. And we're committed to doing that, regardless of who's in the executive branch or who's at Treasury.
All right, welcome back. That was the Minneapolis Fed President, Neil Kashkari, speaking earlier to us about the policy outlook amid, of course, this bounce, this massive move down in treasuries overnight. I think we reinverted on the 2s and 10s curve. The other big story, which suddenly reappeared, is the Trump tariff threat. And as you can see on your screens, it's everything but the dollar and the yen. Aussie dollar's off 8 cents of 1%. We're looking at substantial weakness coming through in the Mexican peso, in the loonie, and also in the Chinese currency. We should be getting the renminbi fix of the day anytime now. We'll be flashing that for you on your screens once it does drop. Let's bring in Helen Ju, Managing Director and CIO of NF Trinity. Well, first, nice to see you and good morning.
Morning. Nice to see you guys.
Markets have rallied on the positives, on the good side of the Donald Trump trade. We're starting, arguably, to see the negatives right now play out in these markets. Way both sides for us here.
Well, Rish, I think the market's gotten very, very excited about the good Trump, right? It's not only the pro-growth things, the, reduced regulation aspects that people love for financials, for big tech, but it's also actually recently the unconventional things that unleash the room for imagination and unleash the animal spirits, whether it's the comments about crypto or setting up this Dodge commission, which was totally, unexpected and very, very unconventional. People like it, and people think that he's going to have tremendous change that's positive for America.
Right.
And so I think that actually is what pushed up the market, right? The first derivative benefits are basically financials, big tech, and maybe some consumer discretionary and the U.S. dollar for sure. But I think actually probably the market starts to now think about the second derivative beneficiaries of the good Trump, and then eventually, probably after a period of time, price in more fully the potential negatives of the bad Trump that may or may not materialize.
Talk us through more on the bad Trump side. What does that actually look like? I mean, most people would talk about sort of the inflationary part of some of his policies, what that means for the Fed, but you're seeing, of course, a very clear reaction on the tariff risk as well this morning.
I think absolutely. I think everything basically around the bad Trump largely revolves around the tariff threats that he's made, not only against China, but actually against the rest of the world as well, right? The 60% headline for China, the 10% on the rest of the world, et cetera. So yes, you mentioned that that would be inflationary for the U.S. for sure, and that is still a concern for a lot of the U.S. consumer, many of whom actually voted him into office. So that's actually one factor to keep in mind that might actually, rein him in a little bit. But for everybody else, he wants something out of this negotiation, right? I think he realizes at the end of the day that imposing all of these tariffs are not necessarily not only not good for global growth, because, we see sell side basically cutting global growth by even 1% for 2026 if everything goes into place, right? And 1% is, quite a lot for overall global growth, and will have impact on the U.S. as well. But I think Trump basically realizes that this is a negotiation ploy. He's going to use it to get some other things that he wants, maybe economically, maybe more likely geopolitically. He's talked very vocally about wanting to end the war in the Ukraine and Russia, for example. That could be something that he puts on the table. So I think we have to watch for all of that. But right now what's happened in the markets is that people assume that the U.S. is on the offense and everybody else is on the defense. The dollar has obviously strengthened. So all the exporters have actually weakened. Even Mexico, supposedly, the U.S.'s closest trading partner and much more reliant on U.S. trade versus China or the rest of Asia, has really corrected very sharply as well. So bad Trump is priced in for the rest of the world to a large extent, maybe not to a full extent, but a significant extent. Bad Trump is not so far reflected in the U.S. market. But as we get closer and closer to it, it may become more and more priced, which might actually rein in Trump a little bit more.
Is bad Trump in the U.S. context potentially more inflation? And what does it mean for the Fed that, up until, in fact, even before the whole Trump trade came, there were already doubts whether they could cut interest rates as quickly as they can. And then there's the additional prospect of Trump maybe reflating the U.S. economy.
Absolutely. I think the move up in terms of rates recently at the front end as well as at the long end is a reflection of the fact that people think that Trump is pro-growth and very positive in terms of fiscal stimulus, et cetera, extension of tax cuts. So that's already happened, and people priced out a number of rate cuts for next year already on the back of this, right? And people actually have higher expectations regarding longer-term growth. But you're absolutely right. Part of this factor is also the inflationary pressure, because previously most of the tariffs are actually on industrial goods, and a lot of things were actually exempted. So if you look at China's exports to the U.S. of $500 billion per year, the actual China tariff payment to the U.S. is around 100, so around 20%. But I'm guessing roughly that around 200-something billion of consumer goods were actually exempted from this, because you're not paying on iPhones, for example, right? He didn't want this to actually pass on to the consumer. So for the remainder, which is to be or industrial products or cyclical manufacturing products, it's probably roughly around 30-35% is the math. It kind of sticks together, right? If he imposes this 10% incremental because of the fentanyl, et cetera, that we saw this morning, then let's say for that 300 billion, maybe an additional 10%, so maybe 30 billion of incremental tariffs. That's not a huge number to China. That's like, 0.2% of GDP and 1% of, total exports per year. It's obviously had a much bigger and disproportionate and will have a bigger and disproportionate impact on asset prices and sentiment. But in terms of the U.S., they will collect 30 billion incremental revenue. It's negligible compared to the incremental, other effects that he's trying to achieve, right, which is not really just the incremental revenue. So I think, inflation is something on the consumer especially that one has to take into consideration, because a lot of the consumer products have no real substitute effects, effectively.
It's difficult. It's going to take time at least.
Exactly. Yeah. It will never be economically viable in the U.S., so it can only potentially transfer to other markets over time. But then if you start to tax other markets as well, then you have all these problems, right?
But even if it is sort of a rounding error, it certainly sends a message of decoupling between the US and China, or further decoupling. So what is the best way for China to manage in this environment?
I think it's going to be really difficult because, firstly, I think that China doesn't have too much to offer in terms of economic incentives for the U.S. There can obviously be more imports on agricultural products, which was talked about in the first Trump deal back in his first administration, but not necessarily executed to the full extent because of some of the disruptions and demand changes because of COVID. There's the headline issues like the fentanyl, which I'm sure they'll do more on. I think one of the other things that Trump may want Chinese assistance on would be the geopolitical side, if he wants to end this war in the Ukraine. And by the way, if you end the war in the Ukraine, that would actually have a very positive impact on commodity prices in terms of bringing down oil prices at the pump in the U.S., which Trump has spoken very vocally about wanting to do because he realizes that hurts his constituents. So, if you actually don't put on too many tariffs and you can resolve the war issues with China. With China's assistance, you can bring down overall energy prices in the U.S. That's actually a win-win-win. So I think that's an avenue that probably people who want to negotiate with him will consider.
Yeah, in fact, on that point, I think we're already seeing today this drop in oil prices because of the other issue in Israel. What does it mean for investment strategy next year? So this year, stocks have done well, bonds up until a few months ago, credit's done well. So what does next year look like?
Look, I think in 2025, in the beginning, people are still going to be on this good Trump trade, right? Because of animal spirits, because of the room for imagination. First we got Dodge. What is the next Dodge for over the next 2 or 3 months? It's entirely possible, and people can see all of this idealistic optimism playing out, and with reason. But I think the second derivative on the good Trump trade is not what's already gone up, but maybe if there is indeed global growth and not much in terms of bad Trump emerging, then the cyclicals will catch up, the factory automation, then maybe some of the other exporters that will benefit from stronger U.S. demand. I think those could actually do better, and maybe even U.S. small caps as well, because of stronger economy and probably less regulation against M&A. So those would be the further pro-Trump or good Trump trades. But as we move into the second half of the year and get closer to maybe spring, and people talk and focus more on the bad Trump, then if you want to hedge that because you think it's going to be really, really bad, then I think definitely buy puts. The VIX is not, the vol is not that high. You should look at treasuries, probably not IG, simply because credit spreads are so narrow right now. Everybody's pricing in a Goldilocks scenario. But if you actually think that maybe things will end up being reasonable, yes, there's going to be some collateral damage, but overall speaking, no one wants the tariff war to get out of control because it's mutually assured destruction at this point in this world. And if you think that you want to bet, you're bolder and have higher risk appetite, you want to bet that this thing's not going to turn out as bad as what's priced in, then, you would look at, Asian exporters, non-U.S. currencies, you would look at, pro-cyclicals outside of the U.S., and maybe eventually even China as the biggest potential victim, and therefore the potential biggest bounce in terms of a relief rally. But not right away, because we're not going to have clarity.
Well, that's for the spring, as you mentioned. Right? That's for next year.
Hopefully. Yeah. But, I think the earlier the better, because the longer this uncertainty lasts, the worse it is for the global economy as a whole. And so at some point, and I do think that he wants to resolve these geopolitical issues earlier rather than later as well. So if we can bring up the timeline to first half of the year, I think that would be very helpful.
All right, Helen, thanks very much for your time this morning. That was Helen Ju there, Managing Director and CIO of NF Trinity. As we look ahead to the open of mainland and Hong Kong markets, this is Bloomberg.
Right, welcome back. Just under, 4 minutes away from the opening bell. We're a step closer to 19,000, and we're a step closer to entering or re-entering a bear market. Depending on how this day plays out, NEO shares in focus will tell you why on the other side of this break. The open is next. This is Bloomberg.
Welcome back. You're watching The China Show, and we're counting down to the open of markets. It's really been very much an about turn for how we're looking for the setup today, because we are guiding to start even lower. Broadly, Asian equities actually had been into a day of gains, but we had that news crossing the terminal about President Trump-elect imposing further tariffs on China, in particular also Mexico and Canada, of course.
Yeah, I think it's 25% on all imports from Canada and Mexico.
Yes.
On day one, I believe, is how he phrased that. In China, I think it's a bit of semantics too, right? It's 10% on top of any additional tariffs, which could be 25 up to 60.
So it's getting a head start, really.
Well, talk to us about a 60 first, and then talk to us about 10%. Or just round up the number and just give us one number. You're making it very difficult for us creatives and producers here to. Well,
he said he loves the
math.
word tariffs, so I guess he just wants to say it as much as possible.
Yeah. Okay. Well, it's certainly roiling markets, as we like to say here. As you can see, we're down about 0.3% in equity markets. It's really more in the FX space. I should emphasize that too, where we're seeing the reaction here. I think the Mexican peso is off by about 2%, give or take. Canadian dollar, the Aussie dollar is down about just under 1% right now. Okay, let's change things up, please, and have a look at Hong Kong, where we are just about wrapping up earnings season. I mean, you have a couple of more names here in Hong Kong. I think you have Chow Tai Fook, Luk Fook, set to report earnings today. 19,000, we like nice round numbers. We are, again, very close to that level, and it was just about 2 months ago where we just blew past that before, you know, in the blink of an eye. Yet here we are, as far as that's concerned. Okay, I think a couple of more names to tell you about. So NEO, which got a couple of downgrades recently. I think the latest one was Goldman and CGS. We're down 3.8% on that stock. We mentioned earnings coming through, the second and the third. Vitasoy is actually coming out with earnings as well later today. Now, the reason I mentioned Vitasoy because it's one of the best performing stocks of late here in Hong Kong. The other really good performing stock is Kingsoft Cloud. And I think we had that stock just opening up as well. And the reason I bring it up is that we're speaking with the CFO.
We are, but it is a little bit under pressure, I see today. Oh, unchanged right now. Okay, we can... Oh, no. Okay,
oh, there
anyway.
we go. Live TV. Anyway, they join us in the next hour, so we'll get an update on the market outlook here.
Big number of guests ahead. But let's get more with Laura Wang now. She's Chief China Equity Strategist at Morgan Stanley. And, yeah, we've got a couple more earnings to go, but we're basically in the rearview mirror now for the third quarter. So... in aggregate, you could probably say it hasn't been the best of seasons, do you think?
It has. It's basically one of the worst earnings quarter that we have ever seen over the last 13, 14 quarters. Frankly speaking, we've already been having 13 consecutive quarters of earnings misses from the Chinese equities in aggregate. And this quarter is not showing any signs of improvement. If we use MSCI China's universe as an example, actually close to 30% of all the constituent companies net have disappointed their investors on the earnings results.
How about in guidance? Anything stand out?
In terms of forward-looking guidance, I think investors are trying to look for positive signs, but what we are hearing from corporates is basically rather a gloomy picture, right, with what's going on the macro side, with what's going on with the deflation. So basically, if you look at where we stand for forecast for the entire year of 2024, we are forecasting 6% for this year, and we only have 1 month more to go. And the consensus is still sitting at 17%, which we think is absolutely impossible. So what's going to happen is there will be very significant downward revision in the next couple of months as we hear more about the fourth quarter's results.
So downward revisions, then do you think we're sort of nearing the bottom of this or it gets worse from here? Because then you're going to start to have base effects that also come into the figures.
I think it's unclear at this point. Because if you look into 2025, which we originally was hoping to be a year for the earnings growth bottoming out and the inflection point. But I think outlook at this point is becoming unclear because next year's GDP growth is being revised down as we speak. Our official forecast for 2025 for China's real GDP growth is 4%. And on top of that, we're expecting a close to 1% of deflation, which means the nominal growth would be just slightly above, barely above 3%. And that's the lowest nominal growth we've ever seen in the last 15 to 20 years, except for a very short dip at the beginning of the COVID period. So I think with that kind of a nominal growth, which is an environment most corporates have never really dealt with, what we should be expecting is even further slowdown of earnings growth. And if we can see some major policy pivot from the government side at some point next year, there could be a chance for that inflection point to take place. But otherwise, I'm not very positive at this moment.
That's on an index level. On a sector level, though, I would imagine there will always be opportunities. And you guys introduced this bull-bear earnings framework. Help us understand what the framework is, and then we'll talk about what the framework is giving out as far as signals.
Absolutely. We all understand China equity market from the index level hasn't been performing that well over the last several years. But what we have found through our analysis is that the market has indeed become a lot more alpha generating focused, which means the stocks that can deliver very strong earnings beat or upward earnings revisions indeed can outperform the rest of the market in a very significant way. So the earnings framework you were just referring to is something we recently introduced. We actually want to look at the entire market from a top-down level by sector and by industry, and then further at the stock level. And we want to look at the potential possibility of upward earnings revisions and the potential possibility of beating the consensus estimates for the sectors and for the single stocks. And also we want to look at the possibility of these companies revising up their dividend payout and actually do more shareholder enhancement activities such as share buybacks and such as paying out more dividends. So with that kind of approach, we would be more accurate, hopefully identifying single stock and the sector industry level opportunities to create that alpha and outperform the market. That's what we are aiming at in this environment. Yes.
Which sectors in particular, and also how specific do you need to be? Because I kind of think through, for instance, the tech earnings we had, and they were mostly weaker, but then there were some like JD, for instance, met estimates, a weaker outlook, but Xiaomi, for instance, outperformed with the EV. So how particular do you need to be?
With this framework, you can actually get as specific as you want to. At industry and sector level, what we have found is that sectors such as consumer services within consumer discretionary, pharmaceuticals, and media and entertainment, they really stand out. They are standing with the best chance of upward earnings revisions in the coming months and quarters. At the same time, on the valuation front, they are trading actually at below half standard deviation below their 5-year average of valuation. And then the sectors that actually stand out as being the worst positioned, those include the semiconductor sector as well as the property sector. They actually are showing the worst upward earnings revision outlook. At the same time, they are trading at 1 standard deviation above their 5-year average valuation. So those are not good choices, either from a valuation perspective or from an earnings revision outlook perspective.
Why aren't semis standing out to you? For a good reason. I mean, this is a sector that could benefit a lot from government investment, for instance.
That's correct. In China's environment, the semiconductor sector actually has a very strong correlation with the overall macro consumption environment because a lot of the products actually go into the consumer electronics and related categories. And if you look at what's going on in China right now, you can see the retail sales has been slowing down from a growth perspective, only trending at 2 to 3% year on year, which is very low. And the deflation is effectively suppressing consumers' spending patterns and activities. This is, I think, contributes a lot to the relatively gloomy outlook for the semiconductor from an earnings generation perspective.
Now, as far as how this is actionable, I think we've established that earnings beats are a reliable indicator of future outperformance, let's put it that way. What is the time frame for that? Future performance, for example? Are we talking a month, 3 months? How do we determine tactical trades in this sort of, with this framework?
Absolutely. So basically, with our analysis, it shows that on a 1 month basis, particularly after the earnings results are out, companies with earnings beats will deliver the best outperformance versus those actually missed the earnings estimates, and on average they would deliver in aggregate 1 to 2 percentage point of alpha generation. So with 4 quarters in a year, in theory, cumulatively throughout the entire year, you would have achieved high single digit of alpha generation.
Okay, so we've established what the next month looks like. We'll talk more about the next year. Laura Wang will be rejoining us in a couple of minutes to talk us through their 2025 outlook there. She's with Morgan Stanley, of course. Right, just ahead here on shows, and we just talk about earnings there. More on the earnings front with Chow Tai Fook, set to report results later today, and really how it's coping with weak consumer sentiment in its key markets. Stock is up 1.1%. This is the China Show. Welcome back. You're watching the China Show. On your screens are some of the projections and targets out of Morgan Stanley, base case for 2025. And as you can see, some of the Chinese benchmarks are there. In fact, if you joined us, for some of our viewers that tune into our U.S. programming, Mike Wilson, of course, joined our colleagues on surveillance, of course, overnight to talk us through the U.S. equity component of the broader global component there. Hang Seng Index 19.2, target 19.4. In about 12 months from now. Laura Wang is still with us, Chief China Equity Strategist at Morgan Stanley. So what does next year look like? So we know what the endpoint is. What does the path to that endpoint look like currently?
I think what's likely to happen is that we will be facing a lot of front-loaded headwind. I think as we woke up this morning, we're already hearing some headlines about a potential tariff being imposed on Chinese imports into the United States, et cetera, et cetera. And this has been a widely discussed topic over the last several weeks already, right? So aside from the tariff debate, there will also likely to be some other non-tariff restrictions towards China. And the timing is likely to be very soon, very imminent in the coming weeks or in the next couple of months. However, if we think about what we would be expecting from the policy side domestically within China, we would be expecting the government to actually step up the fiscal easing to potentially support economic growth and try to fight against deflation. However, that's likely to come much later in the year in 2025. So unfortunately, we will be facing this timing mismatch of the front-loaded headwind versus the potential support from the fiscal side to try to rejuvenate demand and consumption and investment, but at a much later timing. So I think what the investors need to be aware is to buckle up and just be very prepared for the initial heightened volatility and then look for potential opportunities later.
So you're essentially expecting markets to go further down before sort of recovering, because the target prices aren't too different from where we stand today. For most of the indexes there. Is that right? Is that what you're saying?
I think trend-wise, that's very likely to be the situation, because if you look at the price target towards the end of next year, as David just laid out, we effectively see very limited upside from where the market is trading now, right? But as I said, at the beginning, the volatility is likely to be very high. China's equity risk premium is likely to be pushed up, which usually means that the valuation would be suppressed. And we just talked about the earnings outlook, particularly at the initial phase, with the absence of meaningful fiscal policy step up. It's very difficult for investors to believe that there will be a earnings growth re-acceleration. So with earnings being revised down continuously, whereas the valuation being suppressed with a heightened equity risk premium, we should be expecting the overall market to take a dip or to experience very heightened volatility in the initial phase. But hopefully the policy support will come later, and then with a more stabilized environment, so that we can expect more relatively index level stabilization and also sector and stock level opportunities.
Laura, I still remember almost exactly what you said. I think you joined us right after that PBOC briefing. I think it was almost exactly 2 months ago. And I think what you said back then, and you mentioned multiples, right? I think we're going to fire the chart on PE, is that the reset to, I think, 10 on MSCI China, that was the reset. For us to get from 10 to 10.5 to even 11, we need inflation to come back, because that's the margin. Right?
Correct.
Do you see any path between the current level to the end of next year where inflation comes back, and hopefully we get this multiple bumping up a little bit even further?
I think you're exactly right, and we still maintain that view. If you look at where the market is trading right now, it's really just around 10 times, right? So I think the market is already trying to give credit to what the government has done so far, providing liquidity support for the Asia market directly, and the rate cut, triple R cut, and some of the other announcements they've made along the way. So the market is already giving a high enough valuation, 10 times, versus previously before the end of September, what we saw is somewhere between 8 to 9 times, right? So I think that credit is to basically value that the market is likely to be giving out higher dividends, and which can sustain that valuation at 10 times. But to go from 10 to 12 times or 11 times, that basically means that you need to redeliver the reflation. You need to put reflation back on the table. And the reason we don't have that 11 or 12 times 4P as our forecast for 2025 is because we cannot represent the government and say that pivot is really going to happen at some point
or
next
it's working.
year. We are hoping for that to take place, but I think we should just take this very carefully, and we should monitor the policy announcements very, very closely. And if there are initial signs of major step up of easing, then I think the government will be very clear about it, and the market will try to also reward the valuation to reflect that kind of action taking. But at this point, without such kind of a forecast or expectation, I think the market is very likely just to trade around the current 10 times forward PE.
What can we actually expect from the government, though? Is it something of an even greater magnitude than what we've seen so far?
At the moment, we've seen the swap program and the relending program from PBOC, and that's providing liquidity for the Asia market support, right? And then we have the relending program that's helping taking out some of the excess inventory from the property market, but total amount is not enough. It's only 500 billion RMB. But we think the actual amount of the excess inventory in property market needs another 3 to 4 trillion RMB to actually completely digest the inventory. And then, of course, we would like to see some other support to stimulate consumption from consumers directly. And I think some potentially effective measures could be subsidies for multi-child families, and some reforms or subsidies for the social welfare, social benefit distribution, etc. And those could actually be very effective in terms of, in the short term, stimulating the consumption behavior. But we're not yet hearing more news on these fronts.
I'm curious what you think, and who knows really what 3 years down the road looks like, but it seems everything that they've said so far and everything that they might say next year addresses or unlocks, addresses the structural pain points in the economy. And I'm wondering whether the 3-year outlook might substantially improve once we do see the current set of what the game plan is. And how do you look at the long term is what I'm trying to get to.
We definitely hope there will be a light at the end of the tunnel. And I always use the property market as an example, right? Because as we all understand and probably agree on this, property market, the slowdown of the property sales and the investment cycle has been a major drag on the economy. So even without any additional stimulus or measures from the government to take out excess inventory in the property market, the excess inventory should be able to clear itself up within the next 12 to 18 months. The reason for us to say this is because if you look at the current excess inventory in the market, total inventory is around 25, 26 months of sales. And you want that to drop below 15 months, which is the historical average, to be considered at a healthy level. This means you actually have another 12 to 13 months of excess inventory. So even without any additional measures, these 12 to 13 months of inventory should be gradually digested with another year of gradual sales of the primary house. And after that, usually you would wait for another at least 1 to 2 quarters before the investment cycle of property to finally start to pick up and reaccelerate. And then the drag on economy in terms of decrease of investment, decrease of sales, and job losses for all the relevant sectors, I think those impact would be gradually actually disappear. And then I think the situation will be much different versus what we are in at the moment.
There we go. The 18-month outlook. We covered 16 minutes. About 150 pages here of the Morgan Stanley, the free reports. Laura, thank you so much. Let's talk again. Fantastic insights there, Laura Wang, Chief China Equity Strategist at Morgan Stanley. Chinese markets have now turned green. On your screen shortly. Plenty more ahead. This is Bloomberg.
Chow Tai Fook is set to report first half results today, and analysts think its earnings outlook could be dragged by weak retail sentiment in Hong Kong and China. Our Bloomberg Intelligence senior analyst Catherine Lim joins us now. And Catherine, firstly, just talk us through more what we're expecting, and secondly, is there any sort of solution to this?
Well, Annabelle, the company will be reporting their results from April to September. And we know that, consumer sentiment, as you've highlighted, across Greater China, whether it's on the mainland, Hong Kong, it wasn't great. And that was before the stimulus came through. Now, when the company actually highlighted and shared with the market the second quarter retail sales, which is, July to September, they did indicate that, into the October National Day holidays itself, things were picking up. Demand for jewelry and even the pricey gold was actually picking up. So the key really tonight is whether that held through for the last 2 months, and whether, in the entire uncertainty, that we're seeing for the broader markets itself, the appetite for the pricier gold will hold up into 2025.
Any read through, and just to get into the weeds of things, Catherine, is there anything any read across from trips, for example, to Hong Kong? I know it's getting fairly busy. I know you're in Hong Kong a lot, and you notice the crowds coming through. And I also want to ask, I'm not sure if you've looked into this, I think they've launched this new brand, Hearts on Fire, if I'm not mistaken. Anyway, sorry, I'm just rambling through there, but go ahead.
David, it is indeed, the Hearts of Fire, and that is the jewelry side, the diamond side of things, which is the higher margin category of the business compared to gold. So, we are in the quarter whereby, you may see it, David, Annabelle, that this is the seasonal period for more weddings to be held. More celebrations out there, and naturally the seasonality, reasons will drive an uptick in jewelry demand. But we're coming from a high base from last year itself, so I'm not expecting incrementally, a lot of the improvements from this quarter, even though the momentum on a sequential basis is picking up. But we'll have to see. I do think that, one thing to bear in mind is that the Lunar New Year will be earlier next year in January itself. So that may actually drive a little bit of that calendar shift in demand.
Yeah, before Valentine's and before Hearts will be on fire, hopefully. Catherine, sorry for that. Catherine Lim, our Bloomberg Intelligence senior analyst. The Hearts on Fire that I know is from Rocky IV in the soundtrack for you OGs out there. Anyway, lots of good conversations coming up on your screens at those times. Plenty more ahead here on The China Show.
Welcome back to The China Show. Here's a look at a really beautiful skyline of Hong Kong this morning, but the Hang Seng, it's kind of trading sideways right now and probably doing better than a lot of Asian equities because we've got the broader benchmark in the red, but Chinese equities have just managed to turn at least sort of flat, even though we've got the tariff news very much directed at China this morning. Yeah,
the additional 10% on top of any additional tariffs. I think Steve will join us in a couple of minutes to unpack that and what that really means for these markets. But yeah, as Bill is pointing out, comparatively speaking, Hong Kong is doing better than most in the region. Although if you take I think a 4-week step back, we are still on bear market watch for these Chinese markets, 18% down from the peak. Asia ex-China is looking like this on that very note. So the moving yields down overnight is unwinding a little bit as we speak, on the 10-year in particular, where we are flat right now. The 2-year still slightly down. I think we have a 5- and 7-year bond auction coming through out of the Treasury. Mid-week, as you can see, Japan is leading these losses, 1.4%. Apart from that, Brent crude is pulling back. Big drop in Brent crude, big drop in defense stocks across the region on the back of the news or the prospects of a ceasefire as pertains to Israel. We're looking at energy stocks on that very note. Let's flip the boards, please, and have a look at that, too. So oil, you have Brent, West Texas, Shanghai oil, down about 2%. We're down about 1% on energy stocks and U.S. Treasuries on that note. I think 2, 5, 7, and 10. And then you do the math between the 2 and the 10 gives you that re-inversion up the yield curve that's coming up on your screens very shortly. And yeah, you got to wonder whether we've actually structurally shifted higher on the Treasury movements here. Is that coming soon? Yes, thank you so much. There we go. And on the re-inversion, please, very, very quickly. It happened very briefly overnight for the first time in a couple of months. So you do the spread between the 2 and the 10, and there you go. So the dip below the zero handle we're now -1 on the curve. Now, this takes us into from one big story to another, and on the Trump news and this dollar strength, which is, I guess, it's a common denominator among all the major market themes today, Bill.
Yeah, that's right. We're seeing it stronger against the Mexican peso, against the Canadian dollar, against the yuan, Aussie dollar, of course. But let's get more on the Trump tariffs news, bring in our Chief North Asia correspondent, Stephen Engel. And, yeah, I mean, it's additional tariffs, really, as Dave was saying.
We've had a lot of debate in the newsroom about is this an additional on top of the 60? Is this good or bad? Let's just put it this way. This is Donald Trump on Truth Social saying on day one, January 20th, he will apply this 20% tariff, extra tariff on Chinese goods because of what he says is the lack of action on countering the influx of fentanyl and other illegal drugs through Mexico. And that's another reason why, in another post, he essentially said Mexico and Canada will also get 25% tariffs extra on day one if they do not remedy not only the fentanyl influx, but also the influx of illegal immigrants, which he says are coming from both sides, on the southern border and the northern border. There's big ifs there. It has nothing really to do with the pledge on the campaign trail of 60% tariffs on Chinese exports across the board. So some people have been asking, well, it's 10%, not 60. That's good for China. Well, no. This is an additional 10% on top of the threat of 60%. And that's how he clarified it. Let me just read his words so you, the listener, can see it. And you can bring it up on the screen as much as we have. This is Donald Trump in his Truth Social post. I have had many talks with China about the massive amounts of drugs, in particular fentanyl, being sent into the United States, but to no avail. Representatives of China told me they would institute their maximum penalty, that of death, for any drug dealers caught doing this, but unfortunately, they never followed through, and drugs are pouring into our country, mostly through Mexico, at levels never seen before. Until such time as they stop, we will be charging China an additional 10% tariff above any additional tariffs, that's the 60%, on all of their products coming into the United States of America. Well, there's got to get your reading glasses to see that. I did it for you. So again, we all know the trade disputes between China and the United States. Taking on Canada and Mexico adds a whole nother specter of possible inflation, disruptions to supply chains, absolutely. Keep in mind, and energy prices, the largest external supplier of crude to the United States is which country? Canada. Okay, their biggest export to the United States is oil and gas. So energy prices potentially are in flux there. The second biggest is car parts and autos and trucks. The supply chains of the automobile industry in the United States is so tied to Canada. What does this do for supply disruptions as well as inflation? And then consumer goods are number three. Agriculture, also a big component, which there's huge integration between the agricultural products of the United States and Canada. So again, he's calling on these countries to take action, and then if they don't meet his needs by day one, he'll apply these through executive order.
Well, that's 2 months away, so anyway. Steve,
that's an eternity, right?
And that's a short runway, too, to be able to come in line. Well, separately, and I think not to confuse it, there's the other story that you've been covering, too.
Yeah.
And speaking of action, that the EU and the G7 are preparing action against China, including China and Russia, over the war in Ukraine.
Yeah, that's right. So, again, China in the crosshairs here on these actions, on documents that have been seen by Bloomberg News. Let's take the EU action. First of all, they're proposing to sanction several Chinese firms that it claims helped Russian companies develop attack drones, similar to what, again, Bloomberg News reported in July that potentially, allegedly, Chinese companies have been working with Russian manufacturers to build drones for the battlefield, similar to ones built in Iran. So this is the EC, the European Commission, taking action potentially on that. Again, these are not set in stone yet. They could change. This would be the 15th round of sanctions by the European Union against Russia and its potential proxies. But again, there's other entities, companies and individuals that potentially could be sanctioned. Russian, Chinese, North Korean, Syrian, Iranian, even Hong Kong, even Thailand. So it's quite wide-ranging. And finally, G7, they're meeting in Italy. They're wrapping that up today. G7 foreign ministers, they're potentially coming up with a fairly harshly worded communique, basically offering Ukraine unwavering support while expecting, let me say this, we are going to vowing appropriate measures consistent with our legal systems against actions in China and other third countries who are supplying Russia's war machine. Lots to report on today, guys.
Yeah, you're almost out of breath.
Yeah, I know.
Okay.
I'm trying to get everything in. I'm getting wrapped in my ear.
Try that as a skill. Stephen Engel, our fantastic Stephen Engel, Chief North Asia correspondent. there on all the latest and all those top stories. Coming up here on the show, we'll be speaking exclusively with the, Kingsoft Cloud, which is one of the best performing stocks really in the region recently, about really their growth strategy and their plans in China for investment and this national data infrastructure conversation.
But first, we've got Nomura Research Institute Chief Economist Richard Koo on the adequacy of China's stimulus measures. That discussion is next, and this is Bloomberg.
All right, a brief look at the CGB market where, at a 205 yield and a 10-year yield, we're extremely close, if not at 2-year lows. Below that, it takes you back 20 years in the Chinese 10-year yield. We're down a 7th day. Now, juxtapose this against the yield and the melt up we're seeing in Japan, where the prospect of a BOJ that might hike interest rates again, certainly a hike is fully priced when you look all through March of next year. A possible surprise in December might be in the offing. Our guys at Bloomberg Economics think the risk is that the BOJ tilts hawkish in 2025, and really how times have changed when you juxtapose China and where you are here with the Japanese economy, Bill.
Well, certainly CGBs are really indicating that concern around the growth outlook and that possible Japanification of the economy as well. But let's get more on that now. Bring in Richard Koo, Chief Economist at Nomura Research Institute. And Richard, you're someone who's, you conceptualized and brought to life the concept of a balance sheet recession a few decades ago. But now you're talking about China's economy having all the hallmarks of a balance sheet recession. The stimulus measures that we've had since September, do you still see that being a possibility?
Yes. There were a lot of things announced in September and a whole series of them. But quite a few of them are actually, changing the bonds that were issued by the local financial platforms with the actual local government bonds and things like that, or central bank providing money so that companies can buy back their shares. Those are all basically changing the ownership of existing assets. And changing ownership of existing assets, no matter how large the amount is not counted toward GDP, if you remember. Well, to be counted toward GDP, it has to add something, value added to the economy. And when you look at from that angle, all these big numbers that came out are largely in the first category, that is to say, changing the ownership of existing assets. And only one of them really gets into the GDP, stimulus way. And that is the package that was announced, I think, around October 16th, 17th, where the government said, we're going to put together 4 trillion renminbi package, where developers who started a project but were not able to finish it because of liquidity and other problems, if that project is accepted in the white list that the government issued, then the developer can borrow money from this 4 trillion RMB package and finish the project. Now, according to the last report, they said about 2.3 trillion of that is already approved. But this one will definitely add to GDP, because in order to finish the construction of these apartments, they need to get cement, the workers, and iron, the steel, whatever that's needed. So that's the one that will add to GDP. But the other ones that they have announced so far, they're just, of course, they're far better than nothing, in a sense that they will clarify a lot of things and make people feel that the government is finally doing something about the situation. But in terms of really adding to GDP, that's the only package that so far that I can determine will actually add to GDP. And 2.3 trillion is the approved amount, but how much of that actually goes into the construction, we don't know. And still, this is far from enough, given the size of the Chinese economy and size of the balance sheet problems that they face. And balance sheet recession, takes a long time to get over. Japan took nearly 20 years. US and Europe after 2008 also took 5 to 10 years. And this one the Chinese are facing, I'm afraid, could take just as long.
So Richard, I think part also of your of the premise you put forward in your thesis is it takes a long time to get over a balance sheet recession because it takes a long time to deleverage, particularly when you have rational actors like consumers who are acting logically, in fact, to delever their own balance sheets, for example. And I wonder whether a reflation in the property market accelerates that process, in your view. It's something that they're hopefully laying the foundations to achieve.
Well, we all like to see Chinese real estate market stabilize at some point, but they're facing many other problems on top of balance sheet recession. And that is that for people to really, get themselves to buy apartments, there has to be a narrative out there that says, okay, at this price, you won't go wrong. So you can go in and buy these apartments with borrowed money. And that's where the bottom of the real estate market will be. But given that, Chinese population is also shrinking, starting on the same year the bubble burst, these things, if you put these things together, that the bottom that people really feel safe to re-enter the market might be, far lower than under ordinary circumstances. I mean, Japan, a lot of people talk about demographics as a reason for stagnation. But Japanese population was still increasing from the bursting of the bubble in 1990 all the way to 2009. So there was 19 years where the Japanese population was still increasing. So that issue of what is the right place, what is the right price to buy, was much easier because we could still argue that, well, population is increasing. Eventually, they need to find apartments to live. But in the Chinese case, the population is already decreasing on the same year that balance sheet recession happened. And so certainly government doing all sorts of things are helpful, but whether that will actually result in real bottoming out and recovery of the real estate market, I'm still quite doubtful.
Well, I guess beyond the property market, it's really about stimulating consumption and demand for debt across the board. And we don't see anything really coming through in loan demand, neither from corporates or households so far. But you're talking to the demographic challenges that's facing China's economy, and that is, of course, one of the key risks. Given that aging population, how long do you see this balance sheet recession extending? And can any of the efforts that China is making to address that in terms of trying to prop up the birth rate, invest into robotics, can any of that sort of avert the worst of it?
Well, in terms of the bubble itself, I think Chinese bubble is probably smaller than the Japanese bubble 30-some years ago. In the Japanese case, we had 500% increase in commercial real estate in just 5 years. And in the middle of Tokyo, the Imperial Palace Garden was said to be equivalent in value to the entire state of California. So you could imagine that the Japanese bubble was huge. So it took about 20 years to clean up the mess. Companies stopped paying down debt. In the Chinese case, I think as a percentage of GDP, bubble is probably smaller than the one Japan faced 30 years ago. And there's one other advantage that Chinese have over the Japanese is that a lot of people in China are already aware of this disease called balance sheet recession. So many people are talking about it in China. All of my English books were translated into Chinese. That's about 5 books. And so they know what the disease is. Whereas 30 years ago, those of us in Japan had no idea what we were going through. I mean, Bank of Japan brought rates down to 0, nothing happens, fiscal stimulus, no Keynesian pump priming. And so we said, oh, it must be structural, this and that. It was the balance sheet. And so we lost lots of time wondering what to do. In the Chinese case, most people know what the disease is. But the question is whether they have a will to put in this large fiscal stimulus. And one of the key difference between the Japanese and Chinese case is that Japan, the government was running budget surplus during the peak of the bubble. So going from surplus to deficit is not that difficult. But if you look at the Chinese flow funds, what the government budget deficit looks like, the central government budget deficit looks okay, but if you add local governments and look at so-called general government fiscal position, they were actually running deficit to the tune of 7% of GDP before the bubble bursting. And so the years before the bubble burst was actually supported by the Chinese government all along, especially starting around 2016 all the way to 2021. That period, the Chinese economy was actually supported by local government spending. And this is before the bubble burst. This is before the balance sheet recession. Now they're faced with balance sheet recession. They might need another, 4 or 5% GDP fiscal stimulus. But if you already start with 7, and if you add 5 on top of it, you're talking about 12% GDP deficit. And I think that's where people are still very hesitant to putting a large fiscal stimulus. I can understand that given the size of the numbers. But at the end of the day, I don't think they have much choice. Balance sheet recession, as you already mentioned, people are all doing right things, rational things. It's collectively, when they're all paying down debt at the same time, even at very low interest rates, someone has to borrow money and keep the economy going. And this part, only government can play this role because private sector sorts are all doing the right things, repairing balance sheets, rebuilding their financial health. And so at the end of the day, government has to do it. And there should be no financing problems in the balance sheet recession because balance sheet recession happens because private sector is saving too much. So the funds are already available in the financial system. And if government just come in and borrows it and spends it, then the economy should stabilize and start moving forward. But when you see very big numbers, people do get scared.
Yeah, and it seems to your point that a big number is needed, and ironically, debt might be the answer to the debt problem. So it brings to mind the role that the central government leverage profile comes to mind, and how much do you think the central government needs to lever up to address some of the and they're a top-rated issuer as well, and with rates this low. And I'm wondering what the prescription is. If you had to advise economic planners how much you have to lever up to solve the problem, what would that advice be, Richard?
Well, the Chinese flow funds data comes in very, very slowly. And so we really don't know how much excess savings the private sector is generating. And so I will start with any large number, let's say 4 or 5% of GDP. But if I were advising the Chinese government, I would say, we're going to do whatever it takes, as long as it takes. And this could be, very many years. But by coming up with something like that, and if that turns out to be too much, then you can always reduce this fiscal stimulus. But if it's too little, then the economy will be going through this deflationary cycle. And, at the end of the day, the medical cost of curing this patient will be so much more expensive. And actually, Chinese did that back in 2008. If you remember 2008, just after Lehman collapse, Chinese share prices were down 72% from the peak also. And I thought China may actually enter balance sheet recession as well. But at that time, Mr. Wen Jiabao, the prime minister at the time, came up with 4 trillion renminbi package. And 4 trillion at that time was a big number. And with that, they were able to avoid balance sheet recession altogether. And they, when they announced this package and claimed that we're going to maintain 8% growth, the whole world was laughing. How could China, so dependent on export market, maintain 8% growth when the whole world is collapsing? Well, they had 12% growth just a year later. And then no one was laughing. People had a full trust in the government, and the economy did very well afterwards. But the problem at that time was that when they saw 12% growth, they should have reduced the fiscal stimulus. But because they felt so good about it, they kept it on. And then that caused all sorts of problems later, too much bubble and corruption and whatnot.
Right.
What we need the Chinese to do now is something similar, but with the provision that if it proves to be too large, we'll cut it. And I'm a little bit encouraged on this front because the other day, Mr. Xi Jinping was seen with Mr. Wen Jiabao. and that was on the news. Wen Jiabao is the person who put together the 4 trillion renminbi package 2008, and if those two are talking, maybe we'll have something going at some point.
Richard, that seems to be a good jumping off point for our next conversation. That's all we have time for. Thank you so much for the time, Richard Koo, Chief Economist at the Nomura Research Institute. Plenty more ahead here on The China Show. Okay, there's some breaking news that we tell you about here based on our sourcing, and this is, Bell might know more on this because you've covered the story too. So Qualcomm's takeover interest in Intel has actually cooled, in some of the details on the screens of where we are as far as this courtship or the lack of it is concerned.
Yeah, so the details of this sort of first surfaced in September of this year, and again, that was Bloomberg sources were saying at the time that Qualcomm was looking at taking over Intel. It would have been one of the largest ever in tech. We're hearing, though, that Qualcomm has cooled on that, and that's partly due to the great complexities it would have entailed. More ahead. This is Bloomberg.
All right, welcome back. So, some breaking news to tell you about here. So Canada has issued somewhat of a response here, of course, to the post that Donald Trump made on Truth Social early on. So you have the ministers there talking about, and they're addressing not so much the tariff, but the issues that underline the tariff threat, that Canada and the U.S. are working together to disrupt, of course, the drug called fentanyl and the border issues with Donald Trump, or at least with the incoming Trump team. That's what we know so far. I'm not sure if you're seeing anything else here, Belle, as far as that is concerned.
It's a really interesting response we're getting from Canada so far because, as we've been reporting this morning, what they're facing is a 25% hike or levies on all products that are being imported from Canada and Mexico. But the concern that faces Canada in particular, it seems, for Trump is that immigration piece. Fentanyl seems a little bit more focused at China, but I guess it depends on how that fentanyl is working its way into the country. That is the response, as we said, from Canada there, and something, of course, we're going to be tracking very closely throughout the session. Mexico's another one we can hear from. Beijing, no reaction just yet. But Trump is making it very clear that he intends to start in his new administration, day one, really pushing through these new levies. But that is certainly making a mark in markets this morning as well, because we have seen that king dollar dynamic playing out once again.
Yeah, it certainly is. And in case you are just joining the programming and wondering what our top story is today and why we're looking at this as well, so Donald Trump, President-elect Trump, a couple of hours back, posted on Truth Social that the tariff threat of 25% on all imports from Canada on day one, and hence you're looking at this big pop earlier on in dollar loonie, dollar Canada, and hence why we're still holding at about these levels there. And that's also why when you look at, say, where we are on the equity market-wise, we're just closing lower 1.2% now on the Japanese markets in the morning session. And this is what effectively the sector breakdown looks like. Asia's down 0.6%. We're held up, interestingly enough, by a Chinese market that's coming off lows of the day, but the rest of the region is really pulling this lower. And it's really, to Belle's point, king dollar, right? At 12.90 on the Bloomberg US dollar. And that's effectively at the strongest or highest level here in the greenback, going back about 2 years or so. Now, from the macro, let's talk about the micro now. And one stock, if you got in, good on you, beers on you, that's done very, very well of late, is Kingsoft Cloud, one of the best performers in the region over the past 3 months or so. In fact, on a graphic, it kind of looks like this. Kingsoft Cloud, you have Kingsoft Corp, of course, which is related. You have the Hang Seng Composite, MSCI China. And this is really, I think, a play on words, king of the clouds. In terms of, they've reported earnings a couple of days back. Since that point in time, a couple of analysts have come out and revised their price targets on the stock itself because of the rally we've seen. So Nomura has gone from 230 to 670. This is, by the way, the ADR share, so US dollar. $3.80 to $6 or thereabouts for Jefferies, and CICC is almost at about $10 from about $6.50, Bell.
Well, I mean, the person who must be very happy about these upgrades is certainly the Executive Director, CFO at Kingsoft Cloud. That's Henry He joining us this morning in studio. And so, Henry, I guess talk us through these analyst upgrades. Does this sort of vindicate your outlook for the business?
Yeah, thanks for having me. Thank you very much. Just want to recap a little bit. I think a few things I want to point out is for this quarter, we deliver 1.9 billion revenue, which is 16% YOY growth. And if you measure on the market, we're actually growing twice of the price of the industry average. And the second part is when you look at the consensus before the earning, everyone expecting we kind of deliver 3.8% on the EBITDA margin. But today, we're delivering from negative 8% before we transit fully to AI cloud to today, this quarter, 9.8%, which is almost 20% up on the EBITDA side. But as you mentioned, there's a few things I want to point out. The first is really about we're generating a very different profile today. So today, all the AI cloud is generating about 22% of the total revenue of a public cloud. And it takes us 2 years. And we take 2 years of the journey, switch from the old generation of the cloud to today is fully AI empowered. And that actually the fundamental driver of the top line growth exceeding market average, EBITDA margin 20% up in the next 2 years. And amazingly, as David probably mentioned, we actually deliver a positive cash flow on the operating side this quarter, which is actually unexpected by many of the investors.
Well, when do you... No, I think we could talk about profitability in a moment there. Let's talk about how you're tracking. So I think it's 1.7 billion... 1.8 billion, let's call it that, on average for the first 3 quarters. Do we get to 2 billion this quarter? How are you guys tracking in the current quarter?
So we're actually providing official guidance for the earnings last week, which I can talk about it. So we feel confident. The fundamental reason is our both public cloud, which are serving the major large language model companies and Xiaomi as well. And also we deployed AI. So we call it AI agents to the enterprise clouds, which actually goes through different vertical industries, financial services, healthcare, so on and so forth. So both of the sectors, we are seeing double-digit growth. So that's why it's give a very solid foundation for the growth for next few quarters. So we are providing official guidance for next few quarters. We are saying we're going to see accelerated growth for next few quarters going forward because the foundation is solid and also the AI-empowered cloud is very different with the traditional IaaS services before.
Okay. Is it too early to talk about profitability? You know, this current transformation that you're in, you're cash flow positive on a quarterly basis. Do we eventually see you guys turn a profit within this sort of next quarter window?
So I just want to, before going there, I just want to give a little context.
Sure.
So 2 years ago, you know, cloud is supposed to be so-called a commodity business because there's no AI, everyone is selling resource.
Right.
But today, we took 8 quarters. We grew the top line from a different level. But when you look at profitability, before we did the transition, our GP margin is only probably 3 to 4%. And today we're getting to 16, 17 and still expanding. And the second part is, as I mentioned, before the transition, our EBITDA margin was negative 9. And today we're delivering positive 10. So it's actually a very different change. If you're doing the analysis from top line to GP margin to EBITDA margin and to the OP margin, you are going to see a continued increasing and accelerated expansion on the margin side. So David, unfortunately, I'm not providing a very timing of the OP margin break even, but we're confident to see 2 things. One is continued expansion of the GP margin. Number 2, EBITDA margin will grow faster than GP margin. And number 3, the management team is very focusing on the break-even of the OP margin, and I'm going to see in the near future. But I'm not going to provide exact timing, but we're confident given the model and the client mix are very different. And we are fully enjoy the benefits of the Xiaomi and the Kingsoft ecosystems, and actually the profile of the profits we're going to see in the future.
It is a very tough market, though, and even with that run-up we've had of late, if you were to take a look at the share price today versus sort of the peak going back to early of last year, it's quite a significant drop. But the need is to try and, I guess, differentiate yourself from your competitors in this space, like Alibaba or Tencent, that also have large cloud offerings. How do you go about doing that?
Yeah, sure. Thanks. I think it's very essential questions, and the team and the management actually thought through in the past few years. We tested different directions, but I think right now we'll find a very visible future and a path going forward. There are 3 things I want to mention. First of all, again, if you're hearing the earning calls from NVIDIA, which is actually an example in AI today, they're all talking about AI factory. So these keywords become so many times in the earnings of NVIDIA. So my point is, Kingsoft Cloud today want to be an AI factory for the entire Xiaomi and the Kingsoft ecosystems.
Right. What does that mean, just in simple English?
So in the simple English is we're going to providing all the AI-empowered cloud infrastructures for all the spectrum of applications, including the EV cars, including the softwares, and including, for example, the robotics and all the smartphones applications. And it is so different today, because when you're talking about AI application, everyone agree as a consensus, the cars, mobile phones, co-pilots become very important applications in the near future. I think that's actually the reason we become very good partner for them. So I just want to share a number. In the IPO many years ago, the entire system internally contributes only single digit of the revenue of Kingsoft Cloud. But today, we're almost generating about 1/4 or 1/3 of the revenue from Xiaomi and the Kingsoft ecosystem.
That's what I want to understand. How much bigger does that become? Because I think for people, if you speak to anyone at Xiaomi, it's a very ambitious plan they're laying out. And it's not just about phones, it's about EVs, and it's about IoT, Internet of Things. And they want to have that full connectivity. And that's the vision of Xiaomi. Today, they're making up around 28% of your revenue. If you were to look out over a longer-term horizon, how much bigger does that become, do you think?
Sure. Before getting there, I just want to share a few more data points, which actually already talking about in different companies' earnings calls. So the plan is going to deliver 130,000 new cars by end of this year by Xiaomi. And today, the monthly active devices connected by the co-pilots of WPS Office is around 600 million users. And there's 860 million IoT devices connected on today's platform. All the devices, co-pilots, and the users will use AI-empowered cloud, which is provided by Kingsoft Cloud, to do all different things. So that's the fundamental reason we're seeing, and hopefully we can increase the 28% of the revenue contribution going forward, and we're confident to see the ramp up. And because, as you know, the cloud, the beauty of that is once you get foundation ready, the user are using the model and the data every day. It's getting better every day by minutes. So it's all coming to accumulated basis for the cloud usage. So that's one point. A second part is also want to talk about is the AI native. As you know, in the old cloud industry, you separate that by IaaS, PaaS, and SaaS services. But today, when you look at the model itself combines the data, algorithm, and infra itself. And you need to connect with different applications. And all the applications makes the model better, and the infra become even stronger. So that's why I'm saying 2 years ago, people separate the valuation by the cloud company's value proposition by IaaS, PaaS, and SaaS. But today, if you also talk about earnings from NVIDIA, people all talk about AI native, which means that there's one company need to close loop, provide all the services and technology available to the clients. That's actually give us a very different business model and a different valuation model because we own the application. But in the old days, the client owned the applications. But today, our client, including Xiaomi and Kingsoft Cloud, we need to be together. So as a simple word, we want to become a cloud department for Xiaomi, Kingsoft Cloud systems, and also our external parties. So that's actually a very different value proposition for us.
Okay. Now, I'm tempted to ask you if you're up for sale for Xiaomi, but I'm not going to ask that question. We can just plant that seed. So here's the thing. So everyone that we talk to about AI is in the midst of, they're trying to figure out this fundamental change. And the gist, the vibe I get from you is you're also trying to figure out how this market looks. You're in the middle of a transformation. Your margins are reflecting that. And I'm wondering how much visibility you have, even just 2 or 3 years down the road. How good does the Xiaomi story get? And how do you keep yourself grounded and not being pulled away and getting carried away with what could be 100x growth, for example? How do you plan a business is what I'm trying to get to.
Yeah, sure. Thanks, David. It's actually a very important question. As a CFO, I need to measure the short-term P&L, the mid-term valuation expectation, and the long-term ROE for the cloud business. Because Amazon took about 12 years from the first year to the profitability, where I probably going to be even shorter. But David, as you mentioned, I think there are 2 things really actually keep me at night. The first part is really about how many productivity elements or the resources you have are categorized by 4. First is data. The second is algorithm or the model. And the third is AI infrastructure. And on top of that, you have different applications. So in my view, I don't think any of the company in the world today occupy or have the 4 different things already under their belt, because it's still new business, everything is growing. But the point is, any company can own a relatively closed loop of the business model, and anything you actually can own more than 2 elements of the successful drivers, you will be successful, which means either you own an infra plus the model, or you have infra plus the data, right? You have different combinations. But out of the 4 things, I think any company want to be successful and want to have a good valuation, need to own more than 2 things. So that's why going to my point is, today, if you look at Kingsoft Cloud, we're working on the infra plus the model itself. But when you look at Xiaomi Kingsoft as a system, we have applications, as I mentioned, the Copilots, WPS, cars, phones, and we're building the infra. But also the data itself, we're running on the entire internal platform. So we actually have more than 3 or 4 things running our belt. So that's actually one part, right? I need to measure carefully on that. But second to your point is, any investment today, you need to generate return. That's actually ROE problem for the business model. And to your question, I think we need to really think about applications and look at how that commercial success can convert to today's investment.
Quickly, the spend on infrastructure is also tough because we have a very aggressive price war in the Chinese cloud market. Do you see that shifting anytime soon?
It's a very good question. So that's actually a bit of a misunderstanding of our business model, because we're not facing directly to the consumers, which means that when I talk about the price war, which is about the price of the tokens, but our revenue model is we are serving the big clients and the KA clients, which means that all the CapEx will be the cost of the client, but the revenue we're charging for them is the training, inference, and the entire AI solution services. So we're not facing directly to the end users, which are actually competing on the token numbers and token price, but we actually make sure our AI foundation and the products can sell with good value-added services to a big company. For example, the large language model companies, software companies are using our AI factory, as I mentioned. So this is actually a very different picture compared with the pricing, so-called pricing wars for the consumer side.
Henry, I really enjoyed the conversation. I'm sure Belle agrees as well. Let's do this again. Henry He there, Executive Director, CFO at Kingsoft Clouds. Just an update here on the geopolitical story we've been tracking all morning here. So we now understand that Justin Trudeau and Donald Trump have talked about border security after the post from President-elect Trump, which sent the loonie and the Canadian dollar to these levels. That's what we know so far. Plenty more ahead. This is Bloomberg. We're tracking currencies very, very closely. Everything from the Aussie dollar to the Canadian dollar to the Mexican peso to the Chinese currency. The effect, of course, is a stronger yen and the dollar on the back of the geopolitical tremors from this morning. And Donald Trump posting about the threat of 25% tariffs on all Canadian or all imports from Canada on day one. And we understand now that the development is after that was posted. The 2 leaders have spoken. We don't know what they've spoken about, but the fact that they're speaking might indicate a thawing of things as well. And of course, at the heart of this is the border. That's what we know so far. The Canadian dollar is off lows of the day, but as you can see, still trading at a weaker level compared to just about 3 hours back here.
Yeah, that's really where we're seeing the biggest market reaction this morning to this Trump news is in that dollar story and how it's playing out. But earlier we actually spoke to the Minneapolis Fed President Neil Kashkari and asked him about how Trump's previous tariff threats could affect global trade and his view on Beijing's battle to revive its economy.
You know, there's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path, you know, reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to. But I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
And that was Neil Kashkari, of course. They're speaking with Haas earlier on the show. Plenty more ahead. Okay, Hong Kong has become a center for financial crimes as Beijing tightened its grip on the city. That's according to U.S. lawmakers who said, and they're highlighting the worsening ties between the former British colony and, of course, Washington. Min Min Lo, our China correspondent, is here to talk us through. There's some nuance to hit here. What are U.S. lawmakers saying exactly?
Yeah, so this is a group of China hawks among the U.S. lawmakers from the House Select Committee. They are accusing Hong Kong, of being now a global leader in financial crimes, if you will. They're accusing Hong Kong of, for example, giving Russia access to banned technology that Russia most needs for its battlefield. They're also accusing Hong Kong of creating these front companies to buy illegal or banned oil from Iran, and also running ships that conduct illegal trade with North Korea, helping with the trade of gold from Russia. And they're also citing this research that says that 40% of the goods sent from Hong Kong to Russia consist of these items that are in a priority list of goods that are being closely watched by the US and EU for sanctions enforcement. So this comes after the imposition of the national security law by Beijing in 2020. And these lawmakers are saying that, look, Hong Kong is being increasingly drawn into China's orbit, and it is no longer the sort of freewheeling society that it used to be, and we need to rethink how U.S. policy is towards Hong Kong and whether Hong Kong should still enjoy the sort of cozy banking relations with the U.S.
Yeah, big question marks over what that means for Hong Kong's standing as a financial hub. But that was our Bloomberg China correspondent, Min Min Lo, there joining us this morning. And as well, a quick check on how some of the stocks are moving, and Chinese EV makers are certainly a big focus for us. But this is a different sort of story. But still tariff talks, but we're talking about the EU here instead, because we know that the EU and China are supposed to be holding these discussions, try and figure out what these levies would look like on Chinese EV makers. It's about trying to encourage them to shift production to the bloc. Yep. But we're hearing that those talks have stalled. And so, wow, quite a significant market reaction for some of those this morning.
Yeah, and I think the conversation there is, we've seen some progress and talks on the part of Chinese car makers to move some capacity, if not already in some cases, to Eastern Europe, I think is one example of that too. The other big story too, so away from geopolitics, well, related to geopolitics still, but away from the Trump tariff conversation, is the pullback in oil prices and the pullback in defense stocks, which is a good thing, underscored by the potential ceasefire in the Middle East. So watch this story very closely. It's playing out in not just the energy markets, but also in the equity markets. Now, going into the 90-minute mark on the Hang Seng Index, and we are, present tense, still flirting with a bear market. We're slightly further off, 0.5% to the upside. Plenty more ahead. This is Bloomberg.